Here with George Coyle, and we want to talk about some concentrated bets here. The idea of these major returns that happen, and because you have so many different situations as a trader. You have people say, especially when you're learning about trading, there's so many different ways to learn about it. You have the guys who are the pick one stock. You have the guys who look for breakouts. You have the diversified guys. You have the diversify over asset classes. You have the diversify as a trend follower. You have the crazy trades that you'll hear about from time to time. Everybody loves the story of George Soros shorting the pound, and talking about it and his full conviction trades. And you got Druckenmiller talking about being a pig. And so George is on today. And I think it would be a good conversation to kind of ask George about some of these trades that have happened over time and what he thinks about this and how it exactly works. And is it a situation where this is replicable? Can we do this in our own portfolios? So George, first off, let's just talk about an easy one. We mentioned this one before, which is Jim Simons. Jim Simons has a situation where he's buying sugar, has this crazy sugar trade, very different from any of the trades he did going forward. So, what can you tell us a little bit about this Simons trade that you were looking at?
Technically, it wasn't him. He had started some kind of textile flooring company with some, I think it was MIT classmates who lived in Colombia, kind of working from memory. But anyway, and he got some money from that. And then he decided to invest, and I'll post this because I wrote a thing about it. But he decided to invest with, whoops, let me put it in the comments. Oh, can you put it in there? I have to join the chat apparently. That's the second one. But he gave money to this guy who more or less, his name was Charlie Freyfeld, I guess, and they had taken a course together at Harvard. And Charlie used econometric models to forecast prices of commodities, including sugar. And basically, they just took a big bet on sugar that paid off. Sugar prices at the time nearly doubled. And so the value of his partnership went up tenfold. And that really gave Jim Simons the money to, he didn't quit academia, but he kind of put it on the side burner, or he freed up his time so that he could spend time managing money and trading and whatnot. And so it wasn't him. And obviously that's not what Renaissance does. They're not taking these huge all-in bets on single commodities, or if they are, that's not what I've read. But yeah, one of the things I guess I'd say is well, first, Simon said it was completely lucky, which I think is kind of interesting. But I've been studying, I talked about that Origins project that I'm working on, where I look at the time periods of people in their early career and how they get to become these legends. And one of the things that's fairly consistent is these guys put on, either directly or via somebody else, allocating money outward, like Simons did to Freyfeld. They put on these huge concentrated bets that end up going right, and that provides them with sort of the modern equivalent of somewhere between, call it $2 and $10 million, so that they can really quit their day job, not have to worry about paying their electric bill or their mortgage, and they can focus full time on managing money. So it's definitely a persistent phenomenon that shows up in the guys who kind of do it independently. And I guess I should say, there's sort of 3 or 4 ways to do it, right? I mean, one is if you're born related to Julian Robertson, that's a good way. But not everybody's born that way, right? But if you get a job at a Soros and you work there for a long time, eventually you, if you do right, he'll send you off with $1 billion to manage your own assets. But in lieu of that, or kind of marrying into it or whatever, one of the consistent things is these guys make these huge concentrated bets, whether it's a venture investment, a single stock or 2 or 3 stocks, or it's, a commodity, options, what have you. And they pay off to the tune of a couple $1 million. And so then those guys can go solo. So it's definitely persistent. You said, is it replicable? I mean, I think it's dangerous to talk about that. There's an Ed Seykota quote that I'm going to quote from memory, but it's something to the extent of the fastest way to make a fortune is to go all in on one thing at the beginning of a major trend. And that's also the fastest way to go broke. So, is it replicable? I mean, you can certainly get aggressive and trade things. If you study how these guys did it, you can do similar things, whether that's like going all in on a single stock, like a Tesla that might go to the moon, or a Bitcoin, or you could use leverage with futures. But I guess I'd kind of refer back to Michael Marcus and say he did that or something like it, and he went broke multiple times on the path. So can people replicate it? Yeah, I think they can, but you might not get lucky out of the gate. And if you don't, you got to go get more money. And I think we've talked about this before, but it's like, do you have the resolve to keep finding people to stake you, or otherwise find ways to find money to make those aggressive bets? But either way, I guess the kind of larger point is just, it is consistent across these guys that they make big concentrated bets that go right. And then often that's not what they do as money managers for a multitude of reasons. But without that big concentrated bet, they wouldn't have actually potentially had the money to go build a money management firm, the runway, the capital, the personal capital, and the seed and capital for their hedge fund or whatever to make it to 5 or 6 years to get enough capital from outside people to make a real business. You're muted.
Yeah, that makes sense. I think that what you said is perfect, where it's like the easiest way to go broke and the easiest way to make a fortune. And it's true. Yeah, that's a great Sakota quote. But it's true. If you look at markets and you look at the way most people go broke, it's think of the bubble Newton was trading in, the tulip bubble. Everybody knows that chart. If you don't know it, look it up. You'll see this massive spike. Newton sells out. He makes some money. Basically, his friends talk about how they've made even more money. He buys back in basically at the top. He loses everything he made and then some. So it's a good study in how these things work and how bubbles work and how your brain will work to once you have this amount of money, once you're making money. It's very hard to just follow a system, like you could walk away with, you could look at the Bitcoin bubble and you could walk away with a couple moves of 200% and be really happy. But you're going to think about that 30,000% that you could have made holding Bitcoin or over all these years. And so you might buy back in at very weird times. This is why you kind of have to have a plan. If you're a trader and you don't have a plan, you're going to lose money. And that's just a fact.
I mean, I guess another thing I'd add is it's timing accounts for a lot. And what do I mean by that? So, the Schwager interview with Michael Marcus, he's talking about, you killed it, Marcus, you made a fortune. And he says, yeah, but like a lot of people were making fortunes at that time. And so I think that if you get in the right market and the right style and the right risk tolerance at the right time, you can make a lot of money. But if you do that in the wrong time, you're going to go broke, right? So that's kind of the risk. And then there's also the competition part of it. So basically, one of Buffett's, he had a huge Geico position. I think it was 75%, but he found this one trade early on, or investment, whatever you want to call it. But it was some kind of like utility out of Massachusetts, sort of just generalizing the idea. And the stock was at $40 a share. And he went to meet with the management and they said, oh, hey, we're going to have to pay a dividend. That's our par value, which was $25. And he's like, oh, well, that's good. And then they said, but we're going to pay 2 units, which meant you buy this stock for $40 a share. They hand you back $50. So like right away, you've made your money back plus 25%. And then you retain the interest in the company. So even if it goes to zero, the stock does, you've still made 25%. And anything up, you make a lot. So I guess my point is, like, I think that timing accounts for a lot, but also a lot of these trades that were available at the time, they just don't exist anymore. And I think that's largely because of competition. So like when Buffett started out, for example, and he's not a trader, obviously, but he was going to meet with managements and nobody really did that. And now most of Wall Street is based on access to managements, and banking and selling products and whatever. But at least like the sell side that covers the buy side, they're trying to give access to managements in the stock world. So Buffett's game is like very, very well trafficked now. And I think that accounts for a lot. But I guess it goes to, back to the idea of can you replicate it? And I think about this a lot. You can certainly do the things, you can study the people, find out what they did, how they did it, and you can do that. But luck sort of has to meet you somewhere in the middle in terms of good timing or good opportunities. And if you're not playing the game, you're not going to get the pitch that you can swing at to knock it out of the park. But I think that the competition in the modern era has made it a lot more difficult. There's fewer and fewer sort of new avenues to do this in. So, and I guess the guys I see do it from the stuff I see online are mostly stock traders these days who take all-in positions on a kind of a prop shop type of stock like a Tesla or a whatever, and it goes way up. There's a Charles Harris guy. He's kind of like affiliated with IBD. He did this amazing like 3-hour 2-part. He like laid out how he had gone from like no money to multi-millionaire to broke, and then he did it again. And like it's one of the more honest things I've ever seen. But he, if you believe him, which I do, I don't see why he would lie about it. But like he was taking huge concentrated bets. Then of course he started to break his own rules and didn't cut his losses, but what have you. So yeah, I'll stop. I'll pause there.
No, I mean, I think so. I mean, for me, I think a way of taking advantage of something like this would possibly be like, hey, I take 5% of my portfolio. I use that 5%. I take maybe 5 options trades, maybe a year. 1% each, 2% if you want to be really aggressive, and look for those big 20-1 bets. But if you're sitting there and you're putting together these huge moves, like let's say in just futures, you're using let's say you have $100,000 account, you're using $1 million of leverage for, let's say bonds right now. You're like, oh, I know bonds are going to work out, therefore I'm going to take this huge bet. A 10% move in the bonds, which isn't impossible anymore, would wipe you out completely. So I think you really have to be specific about this, like and intentional. Understand your risk. Like your options are going to create that asymmetrical risk that you can only lose this much. I'm only going to bet 1% of my portfolio, 2% of my portfolio. I'm going to go for a crazy, let's say penny call or penny put if you're really crazy, and look for those positions. And maybe you hit 1 out of 5. 1 out of 5 on a 10x gain or a 20x gain can produce some good returns, but doing that in your whole portfolio, you can get very rich, but you could also just blow up, and most likely you're just going to blow up. And I think most people blow up, and it isn't because of anything to do with the trade. I think it's just because of how they react to the market. If you're sitting there and you're leveraged to the hilt and you watch this thing drop 1%, and like, let's use the same portfolio size we just used, for example. You have 100,000 portfolio, you're using $1 million of leverage. You watch this thing wobble 1%. You're seeing 1% is, 10K. You're just freaking out about this, 10% loss of your account in a very normal move for this bond. You're going to start to make mistakes. You're going to start to try to sell positions. You're going to start to try to maybe hedge. I mean, I've watched so many people over the years when they start trading thinking that they're going to buy these things and then they're going to hedge these things, and then they're short-term traders, and then they become long-term investors. And like, that's what it really comes down to, is like, you really need a plan. You really need risk management. So it's a really interesting subject.
You need luck too. I mean, that's the reality, and you need the temperament. A couple of things I was thinking of as you were talking, like, John Paulson's a guy I've been studying. He's the guy who made the fortune in the housing market. And he learned early on from Kohlberg of KKR that KKR had bought this company with 72 times leverage. Like, they had, for every dollar that KKR had in the deal, they had $72 of borrowed money, and they made 3,300% or something like that. And so after that, that was kind of like an eye opener for Paulson, according to the stuff I've read. And he was always on the lookout for these gigantic asymmetric payoffs with limited risk. So whether it was an option or not an option. It was structured like an option, right?
Mhm.
And he found it in CDS in 2008. There's another guy in Unknown Market Wizards, Chris Camillo, and his kind of take is he like says, okay, I've read his book and I've read Unknown Market Wizards. I don't remember which one it was in, but his idea, he calls it other people's money. But instead of like raising capital, he says, oh, I could go buy a turkey sandwich at wherever for $10 today, or I could make one at home for $2. And so he'll make it at home, kind of that idea like Buffett had of, this money's worth 10x in how many years, whatever. And then he'll take the $8. So if he would have spent 10 on a sandwich, he spends 2, he takes the 8, he says, well, this is other people's money, so I'm going to bet all in. And he does it. He bets like somewhere between 25 and 50% of his account on each trade. And he does it via, I think, 9-month options. So when they hit, he makes a ton of money, but I'm sure he loses all of it occasionally. But since in his own mind, he's convinced himself that's other people's money that's already spent, he doesn't really care. Sakota, and I'll ping this to you if you can retweet it, but he talks about something, or sorry, not retweet, comment it. He talks about almost certain death strategies, and he sort of likens it to a general who has a couple soldiers, battalions, whatever the proper, I wasn't in the military. So if I'm using the wrong words, apologies. But, like to win the war, you send some guys out and they're not going to make it back, right? And he says you can do that where you're very aggressive and you subdivide your account into, 10 or 20 accounts, kind of like you were saying. But personally, I think the difficulty with that is you still have to stomach it, because if you wind up with like 5 of your battalions are lost, and you've got 5 left, that's still a 50% drawdown. So it sounds nice in theory to say, I'm just going to risk so much of my capital and then I'll replenish. But if they start getting wiped out, you start to be like, wow, I'm kind of running out of stuff. So one of the things that I've seen, like people can use options, calls, puts, whatever, but that introduces time into the equation, right? Theta. So it's like if you buy a call option trying to make 100 to 1 or whatever, you've got a certain amount of time until that thing expires. And it's also losing money slowly. So, if the market goes nowhere and you're basically just holding long stock or futures, you won't lose anything except for potentially commissions or slippage to get out. Options will go to zero. So one of the things that I've seen most guys do is they use what Livermore called probes, and they'll take a fractional position to start. So I think Livermore did, like, if he was going to do a 100% total, whether that was leveraged or not, he'd start with 20%. So let's say he's going to buy 100 shares, just to keep it simple. He'd buy 20 shares. And if it didn't show a gain, he never bought any more. And if it did, then he'd buy another 20, makes 40. And then a little higher, he'd buy another 20, makes 60. And then I think he did 40 shares to make 100 on the last slug. So it was kind of like weighted toward the end. And then he would just sit on it and let it run. And Druckenmiller does something similar. He says where he'll do a third, a third, a third. And I don't think it matters if you do like a third or a quarter or a fifth. It's more just like you get in and then you keep adding and you trail your stop behind. So in theory, you can't lose at least your initial principal once you get to a full-size position. And then it's like, do you do it in futures where you're 10x leverage and you're playing for a move, or do you try to find a stock like Tesla that's going to go up, 100-fold or whatever, NVIDIA, it doesn't matter. And those are all decisions that I guess everybody has to make. But I think within that sort of framework, like obviously I've studied this stuff more than I probably should have, you kind of get a sense of what's possible, how it works. Then you have to decide, what do you do? Go back to Buffett. He wasn't stopping himself out. He just believed in the companies and just held Geico. I mean, he still holds Geico, right? So he's held that stock for, 60, 70 years. But within that, yeah, you just clearly concentration is a big part of what matters. And I'll say another thing and then I'll stop. But I personally, and this will lead to jeers potentially, but I think a concentrated bet leveraged on a diversified trend following system is a concentrated bet. I think that the diversification within a system, you're still betting on the entire system. So the same way I might bet on Apple as a stock to go up, I'm betting on that system and the equity curve of it. And if I throw 5 or 10 times leverage on it, I personally believe that's a huge concentrated bet. So that's not always a popular opinion, but yeah, I guess the point would be leverage conquers all sometimes. So I'll end the rant there.
No, I like it, and I also think in a very similar way. It's the same thing you've talked about before, which is trend followers. If they have a belief in trend following, isn't that the same as having a belief in buy and hold? And it is kind of similar in a sense. So it's the same thing when we're looking at these very concentrated bets. I like the idea of options in a very small way. I do not like the idea of most traders trading options. I think it's a huge way to lose money over and over again. The futures market is a much easier market to trade in. If you're gonna take leverage, you might as well trade futures. Futures you can take leverage. You don't have to worry about time decay. You don't have to worry about all these things that most newer traders don't understand completely. And also, how many stories have you heard of people getting shares assigned to them, or blowing up or losing massive amounts of money at times as they're in trying to make these new options trades, either buying or selling. And I think there's very slim times, and that's why I mentioned it's for me. It's like it's only a few times a year that I ever even take an options trade, and I usually just buy. I used to do all types of strategies back in the day, and iron condors and call spreads, put spreads, whatever. I had all types of strategies I used to run. Now. Very rarely do I do any of those, if at all. I think maybe in the last 3 years I've done maybe two. But now I'll just maybe buy calls in something when they're incredibly mispriced. Look at, for example, the SOFR rate futures. If you go out on the curve a bit, you can basically buy some calls for nothing at the moment, even though the Fed is going to start raising rates. So most of the time, this is what's the only time I'm ever going to say, hey, I'm going to buy some call options, because like you said, most of the time it just becomes a losing game. It's the same thing Dave said too. It's a losing game most of the time. And I think also the other thing is nobody buys leaps. Nobody buys 1 year call options. Because you think the move's going to happen quickly. So therefore, because you think the move's going to happen quickly, you buy them, with a 30-day expiration, and then you're upset when it doesn't move that much in 30 days. It's just not enough time. So you have to really space it out. You have to really understand that there's only very few times a year that it makes sense to even buy call options or put options.
Yeah, I mean, I guess like what I would say to that is it sounds like you've found the right way for you, but what I've kind of learned is there is no one right way to go about it. And
Mhm.
I was certainly fixated on futures guys more, probably because of the original Market Wizards book. But if I think about the people that I've known who've made, not necessarily big percentages, but like big money, it's mostly stock people, not options, but stocks in the last 20 years. And I guess the point is, like, I don't think any one way works, but there's pros and cons to all of them, right? So like if you're going to use options to try to make a ton of money, you're going to have to risk a meaningful percentage of your account. Like, yeah, occasionally somebody will buy a 1% position in a call and then it goes up so much that you make 10,000% or whatever, but you have to risk 5 or 10% of your account to probably consistently make enough money to make a 10x or whatever we're talking about here. But the difficulty with that I've found is like A, the timing part, and B, you're going to lose a lot. And if you lose 4 or 5 in a row, you're down 50%, and then it kind of gets in your head. For me, futures, if you study it, like it's very rare for the futures opportunity set is smaller than the stock market opportunity set via single stocks, right? There's probably, I don't know, 50 liquid futures markets that you're going to want to trade, maybe give or take. There's thousands of stocks, right? And within futures, like nat gas has this tendency to go from like $1.50 to 12 and back. But I think that's one of the biggest movers. Like if you look at the grains and you go back 50, 60 years, they're in a relatively tight range. Commodity markets don't move that much. So a 10% move with 10x leverage is 100%, right? But you've got to put leverage on that, and that can lead to a lot of bad emotions, unless it goes your way every day. So for me, I tend to like it in stocks because it's like, yeah, okay, if you buy a single stock and you're all in, the leverage generally is like 14% a year now, which is expensive, I think. But you can hold it for a long time and let it run. And per the sims I've run, which maybe aren't the most robust in the world, simulations, but it's like to get these 10 or 20 or whatever baggers, I mean, it's very rare that they happen quickly. It takes a while for them to manifest themselves, right? So like, Buffett made a couple $1,000,000, but it took him 4 or 5 years. And these different trades, that the concentrated trades I talked about among the guys who make the couple $1,000,000 so they can go it alone, uh, they they're really like it rarely happens in a month. It tends to happen over a period of years, and that's kind of true of the futures guys too. Usually, like when you read about the guys who killed it, it's like, oh, well, there was a drought, and you go back to one of those historical futures charting software packages and say, oh wow, like they must have held this for a year and a half. So anyway, for me, I've kind of come to the conclusion that stocks are the best way to do it because I just 10x leverage makes me very uncomfortable. And like I said, with the options, it's like you lose, and it stair steps down, and you're like, oh, I don't want to do the next one. And that's the one that paid off. But that's not to say I'm right. I guess the point I'm trying to illustrate is just there's a bunch of different ways people have done it. You kind of got to go through and be like, choose your poison, right? None of them's perfect. Each one has pros and cons. You got to decide for yourself which is right, or if you should do it at all. I mean, I guess that's the other big thing. Like, these books are written about the guys who succeeded. And I personally believe if you live long enough and you keep doing it, you'll succeed. But it may cost you a lot emotionally to get there. So it's probably not right for 99.9% of people, just because it just grinds you down, Say if you knew for sure, like the 51st bet was going to be the one that paid off, you do it. But you don't, right? You don't know if it'll be the 100th or the third or the first. Generally, it's not the first. So I think that's something else that you have to contend with is the uncertainty. Like, will it ever work? You never know for sure. But yeah.
I thought of something that when you said the thing about stocks and making money over the last 20 years, and the macro guys got in a very rough patch. Even I'm not even talking about the macro trend followers, just the macro guys in general got into a rough patch. Basically, let's say 2010 all the way till now, basically. So if you're looking at most of the macro guys, one thing, James Leitner had an interview and he was talking about this, and he said, when I'm going to paraphrase this as my dogs are freaking out. I'm going to paraphrase this, but he said, if you're a equity guy, you get 100 ideas and you take 3. If you're a macro guy, you get 100 ideas and you take 200. And like, it's the truth. And he said that's why the macro guys have done so badly lately, is because when you're in that, like we talk about all the time on here, when you're in that very liquidity driven market and everything's moving and there's a trade everywhere, you can do great as a macro guy. You could trade just about everything. But when you get into that later stage and when it's, only a few sectors are going up and you got to be very specific and intentional with what you're trading, sometimes looking at so many different things is going to hurt you. So I think that's a very interesting thing, and something that I've taken into context a bit more lately, which is I've started to take some tickers out of my systems. Like I stopped trading certain things, oats even. I took that out of there. A lot of the LME, just taking some things out of there because I noticed that as I've grown and as I've gotten into different markets, the returns aren't exactly the same because you start to diversify too much. If you look at somebody even like you look at some of the major, I won't name names, but if you look at some of the major trend followers, you'll see the same thing kind of happen again and again, where as you grow, you start to trade so many different things, you start to venture into so many different areas, and it almost seems like it takes away your returns. And when you back test it, you can see that as well. So I also believe that there's a little bit too much diversification, a little bit too much ideas in the macro guys or the systematic guys, whatever you want to put that. But it's something to think about. I'd like to hear your opinion on that.
The difference between sort of macro and stocks, and I guess like
It's the difference in the you have 100 different things and you take a few ideas as an equity guy, and the macro guys, they have 100 different things that they're looking at, but they take 200 different trades. Just the idea of that kind of what do you think about that statement that James Leitner made?
I've emailed and talked to him before. He's a nice guy, but I guess like I think that's sort of true. Although a lot of stock guys hold a lot of positions, so I wrote this thing called "All Your Eggs in One Basket," and if you can repost it, I'd appreciate it. But it was basically this kind of lineage of Andrew Carnegie and Druckenmiller and Soros and Buffett and guys like that, and they said put all your eggs in one basket and watch the basket closely. But very few people actually do it. So I know what he's talking about, but I think it's rare for a manager to do it. That said, there's a guy named Sebastian Mallaby, and he wrote a book called More Money Than God, which is probably the best researched hedge fund book I've ever seen. His father was some kind of British diplomat, and I don't know if it was because of that, but he got access to like everyone. And the footnotes in that thing are just a treasure trove of like, wow, this guy interviewed everybody. And there was a chapter, I forget the title of it, but it was about basically Tiger and Julian Robertson and how the macro guys that had joined Tiger didn't do very well because their MO was like, the market is right, cut your losses, get out, keep trying things. Whereas the Tiger guys were like, the stock guys there, they felt like if you did the research, you hold that stock, come hell or high water because I'm going to be right. And so most stock guys would be like, well, if you did the research, why the hell would you cut it because it went down? And most macro guys would be like, you're going to ride that into oblivion. I think that's sort of the dichotomy between the two. And I guess I personally try to live somewhere in the middle, a blend. I call it like, well, I'm in Ohio, so I'm between Wall Street and LaSalle Street. And that's sort of my modus operandi. But I guess one of the other things that I forget exactly what you said that made me think of it, but it's this idea of consistency. And, I think that the key thing that I've seen over time is if you're in like a market that's not very well trafficked, like convertible arbitrage in the beginning or Buffett picking stocks, like fine, there's all kinds of low hanging fruit. But if you get away from that, you have to stay consistent because there's going to be good times and bad times for everything. And there aren't the days of one guy making money every single year in and year out, outside of Rentec and market makers, they're basically gone. So I think the best thing you can do is sort of find your best lane within those disciplines and stick to it. And for me, I guess one of the issues that I see with macro, if you're a dedicated, robust trend follower and you're taking all signals, then I'd say that's consistent. But with macro, it's like you might be over here messing with short bonds, and then you decide, I want to be long sugar, and then you're over there long stocks. And so you wind up like when the tailwind comes for a given market, you might not be over here, you might be over there. So I personally like to focus on stocks on the long side because I think it gives you more consistency than potentially wandering within macro. Now that said, I used to love macro and I've just kind of gotten away from it for that reason. But it's not like any of them are perfect. I guess that keeps coming up over and over in the things I'm saying here. But it's, just because I'm focused on stocks on the long side, that's tough. And sometimes if stocks go into a bear market, it sucks. You just sit there and then you're like, I wish I was a macro guy because I could be trading something else. So that's sort of the battle that you have to fight, is decide what do you want to be. But I guess what I see is, and I think I've mentioned this here before too, but maybe 10 or 15 years ago, I'd look at like, who was the best manager this year or that year? And it was not consistent. It was like, well, it was the China focused fund because China crushed it. The Chinese stock market went up a bunch. And then the next year it was commodities and whatnot. And what I sort of took away from that was it wasn't so much one guy who decided to dance between these different worlds all the time. It was somebody who just was there already playing, and then the tailwind came and they captured it because they were there. So to repeat myself at potentially a nauseating level, I think you just got to be consistent. And however you accomplish that, we could sit here and argue for years like, well, macro is consistent because it's more diversified. And I'd say, no, maybe we'd get more followers with one or the other opinion on X or whatever. But I don't think there's a right answer. I think it's like the answer you have to answer for yourself. Just like how much risk do you take? Do you use options or futures or stocks? Do you go for a concentrated bet? Do you not? And that's kind of the unfortunate thing about, I guess, trading in general or investing is, I said this last week, but there's so many compelling arguments. It's just overwhelming, and it's like, well, what do you do? And to some extent, I think experience becomes the answer. You just have to try the different stuff and say, all right, I believe in this philosophy. Like I believe in cutting losses. And sometimes I wish I didn't, because I think life is harder for the loss cutters because we don't have the conviction, right? But, I believe it because it's like, I think any market can do anything. And if you have that belief because you've experienced it, the only way to really protect yourself is to just get out instead of ride it to zero. Now, other people might say, that's hooey, like I can take a small position, but I believe it because I've seen it. And that's just the philosophy I've adopted. Is it right? I don't think there is an absolute right. But if you learn these things, you can find what's best for you and then just try to stay as consistent as possible. So you'll be there when the good times come. So, and rant.
No, I agree. And I think that's what, something that I work on constantly with as a macro trader is the weightings. Like how many, like you said, and I think this is the best thing you said in this discussion, which is something that's so boring that nobody wants to even hear about, but it is so important, which is if you are sitting there and you can go, okay, I'm riding this commodity bull. Let's say it's 2021. You're riding the commodity bull. It was great for traders, especially when you had the weighting right. When you had this weighting at a 50%, let's say you're 50% commodities, 25% equities, 25%, 25% bonds. Yeah, sure. You killed it. You had a great year, but what if you were, 10% commodities in your fund? So you really have to understand those weightings. And then also like, when does it get to the point? And this is something that I'm always working on, is when does it get to the point where if it wouldn't matter if equities and let's say the NASDAQ, any of my stock positions, any of these things are moving really nicely, but what size do I need to make that turn into a good return to my portfolio? Like those things are questions that nobody really asks much. They think that you kind of put these portfolios together and they're just magically weighted the right way and this produces returns. And it's like, no, you really have to think through those asset classes, or how, even if you're a stock trader only, you have to pick the sectors and how you're going to do that. You're using relative strength. How do you outperform the market? All of these things are incredibly important.
Yeah, I mean, I guess I think your weights need to be considered in conjunction with your goals. And I go back to this goals thing over and over, but we're talking about 10x today or whatever the title of this is. Apologies, I don't remember specifically.
Just so people click on it.
Yeah. But the weights part of it, if you're trying to make 10 times your money, you're not going to get there with an unleveraged diversified portfolio. I mean, maybe let's say you're trying to do it in 5 years or less. It's just not going to happen. I mean, unless you get so stupid lucky that it would just be crazy. So if your goal is to do that, you have to sit down and say, well, and I personally think you should study everybody who came before, because this is an old business, and Livermore said it's as old as the hills, and not enough people study the guys who came before. But if you study the people who've done it, it's like, well, what could you do? Well, you could run a trend following system that's quote unquote diversified with 10-to-1 leverage, and you might wipe out, but you could potentially do it that way, right? The other way would be big concentrated bets, and whether that's buy and hold or it's trading, I mean, that's sort of up to you. But I guess my larger point is to your question of how do you decide weights? I think it depends on what you're trying to accomplish. And from there, you'll get a good sense. I mean, let's say you've already made your fortune and you just don't want to lose it, then you're not going to be like, let's go all in on anything, really, except for maybe T-bills if they start yielding 10%. That's actually another interesting topic for maybe next week. But I've started thinking, what if interest rates went to 20%? We know the long-term compound growth rates of almost that post I wrote about Altria is the greatest stock over the past 100 years, made 265 million percent at 16% CAGR. So if you could lock in 20, should the entire business just shut down? But we'll talk about that next week. So anyway, the weights and the sizing, I think, are a function of what you're trying to accomplish. But it gets more complex too, because if you're running short-term systematic patterns, like trying to decide how to weight those is difficult. And then there's also like the stock gang, and the futures gang says, I'm going to size to my stop using ATRs or some other method of how much I want to risk. The stock guys say, I've got $100 million portfolio. I want a $5 million position. So it's like a percentage of the amount that they have. And then they say, okay, stock 5 million divided by stock price equals shares to buy. So it really gets more complicated the further you dig down, depending on which respective discipline of the business you're in. And again, I don't think there's a right or wrong way without the benefit of hindsight.
No, I agree. And it's well said. I think that's you really have to understand your goals, number one, like you always say. And then two, it's how do you diversify in a way that can move? Okay, for example, you can take 20% drawdowns. You can take a 30% drawdown. And I think everybody tells me, oh, I could take a 60% drawdown. They say crazy stuff. And I'm like, I'm sure you can. That doesn't mean it's going to make you money. At the end of the day, it's like you have to have a balance between the guys who have gotten so stuck in their Sharpe ratios and making sure they're netting a couple percent a year or 10% a year or whatever they're trying to get to. And you got to have a balance between that and the people who are like, I could take 50% drawdowns. Like you probably can't, because whatever size you think you can take, you should probably cut it in half. If you think you could take a 70% drawdown, cut it to 35%. You think you can take 50%, cut it to 25%, because really at the end of the day, like you don't know how you're going to react when you are in the middle of that type of drawdown. And then it changes too. If you're a money manager, now you're managing other people's money. Now they're seeing their returns down 25, 30, 40%. They're not going to be okay with that either. So there's a bunch of different ways to look at that scenario. But I think in general, the weighting part of this is so important. How do you weight the portfolios to make sense? And I think that's the other thing. I don't see many back tests using this. Like you have to have back tests understanding the weights of these portfolios, the weights of how many equities are you trading? If you're going long and short, what does your portfolio look like? If you're going only long in equities, what does your portfolio look like? And, if you're going long, short commodities, long equities, long, short bonds, what does your portfolio look like? Like most people can't answer most of those questions. So the more you're able to kind of understand that, the more you're going to be able to figure out like what my goals are. Can this work over time? And then like George says, staying alive for those periods where your strategy works well, because it's just not something that happens constantly, but there will be periods where your strategy is going to come into play and it's going to be the one that's going to be the outperformer. Can you hang on to it? Can you make a little bit of return each year until that time happens? That's questions you have to ask yourself.
It's tough business. I think we all want to get the best of it, but there's very little evidence that I've seen of the ability to get the best of everything. So that means, I'm long short this year, and then I'm long commodities next year, and I'm short China the year after. Just nobody does that well. They might bring them all together, but then you don't get big returns. And if you stack a bunch of leverage on something that's smooth, at least in my experience, it tends to go awry. So you kind of have to decide like what you want to do. But to your comments on drawdowns, just a couple of thoughts. I think most people start to lose it around 30%, like if not 25. It depends on your age, but usually like at least within the kind of retail world, the older people who are closer to retirement, they don't like even 20, 25, they're kind of, and 30, it's like abandoned ship. Younger people just sort of, because they've been indoctrinated with this, like it'll come back. They just kind of bury their heads in the sand, although there are other ways around it. But it made me also think of the When Genius Failed long-term capital book. And there was an investor guy, I don't remember his name, but he supposedly was like a cap intro guy. And he told him like, if you go down 50, it's game over. Now, what's funny about that is, Richard Dennis would have down 50% quarters and maybe months. And, like if you read what Ed Secoda says, he says his system called for and took routine 50% drawdowns. People have told me that some of the other great legends who made fortunes without managing money, took huge drawdowns. I mean, Arthur Cutton, Livermore, like Livermore wiped out, and like Michael Marcus had supposedly huge drawdowns. So we don't see that for whatever reason, or at least it's not written about as much. But like I see these things when I was younger, and I'm like, oh, that guy made 200% a year, and you don't realize the ride that it takes to get there. And I think one of the things that I find is unless you're in you're in sort of a very non-competitive market, back to Buffett with the stock and the dividend that was a 25% guaranteed return, you're going to take huge drawdowns if you want big returns. It's just you can't cheat the hangman, so to speak. So I think that's just something that I think a lot about, and I don't think it gets enough press because it's not the fun fantasy dream. But I've yet to meet anyone who makes 100% a year with no drawdowns. Usually if they go for that, they wipe out eventually. And I think what's more common is people make huge bets. They get enough money to go start a business back to kind of the beginning, and then they don't predicate their business on just gigantic concentrated bets. They typically will diversify to some degree, because eventually you're going to lose if you bet it all every hand. Unless you get them all right, you're wiping out, right? So yeah.
No, well said. And we'll stop there. And this is George Coyle. Guys, make sure to give him a follow. Make sure to hit the notification bell so you guys can check out our show. I've had a bunch of new developments over the last few weeks, so times might be changing. So to stay up to date, make sure you're on YouTube. Make sure you're clicking the notification bell, and I'll keep posting, when we're doing things every week, put on the top of the page. All right, guys. Well, thanks so much, George, for your time, and we'll see you soon. And thanks, Dave. Thanks for saying that.
Yeah. Thanks, everybody. Thanks, Dave.